Right now, there are, I mean, literally tens of thousands of amateur traders sitting in front of these glowing multi-monitor setups.
Oh, yeah, the full command center.
Exactly. And they're furiously mashing the buy and sell buttons like they're trying to beat the final boss in a video game.
Just clicking away, hoping for a combo.
Right. Sweating over charts, tweaking algorithms, just praying for a breakout. But according to the veteran money manager whose notes we're analyzing today for this deep dive, about 90% of them are about to blow up their accounts.
And it's for one brutal but entirely avoidable reason.
Yes, because they completely forgot to check who was standing on the other side of the screen.
Yeah.
So, welcome to the deep dive. Today, we are taking a really hard look at the soaring failure rates in the highly competitive world of proprietary trading firms.
It's a fascinating space right now. So many people are rushing into it.
They really are. And, if you ask the average retail trader why people fail so often, you get the same tired answers.
Oh, always. It's always about discipline.
Right. They'll tell you it's a lack of discipline or bad psychology or maybe poor emotional control or just not sticking to a risk management spreadsheet.
The narrative always frames failure as this, localized internal defect. Like, it's just your fault.
Yeah, like you just didn't try hard enough.
Exactly. The assumption is that the financial market is this perfectly neutral, sterile testing ground. And if you take a loss, well, it's simply because your mindset wasn't calibrated correctly that morning.
Like you didn't meditate enough.
Right. It turns trading into this purely solitary exercise in self-help, which is it's totally inaccurate.
Okay, let's unpack this. Because the core thesis from the veteran trader we are reviewing today, it completely detonates that conventional wisdom.
It really is.
He argues that the real reason traders hemorrhage money has absolutely nothing to do with their morning routine. The underlying issue is they never actually learn the mechanical reality of what the market is doing, or, I guess, more accurately, what the other participants in the market are doing to them.
Which fundamentally grounds the conversation in reality. I mean, it shifts the focus away from those vague psychological platitudes and forces us to look at actual market structure and human behavior.
So it's not a sterile environment at all.
Not even close. When we analyze financial markets, we're looking at a massive interconnected network of human intent, institutional mandates, and, algorithmic execution.
Right. Big money moving around.
Massive money. And if you don't understand the ecosystem you're participating in, all the ironclad emotional discipline in the world will just help you lose your money more calmly.
Wow. Lose your money more calmly. That's grim, but it's so true. And there is nowhere this systemic misunderstanding is being amplified louder than in the current boom of the prop firm industry.
The explosion of prop firms is just wild right now.
It's everywhere. And for those of you navigating this space, I mean, the allure is undeniable. These firms offer a really specific, highly seductive deal.
It sounds almost too good to be true for a lot of people.
Right, because you pay a relatively small upfront evaluation fee, and you get access to a simulated environment to prove your skills.
And if you pass, you're in.
Exactly. If you hit their profit targets without breaching their strict drawdown rules, they hand you a funded account. You get to trade with high leverage, take home a massive split of the profits, and you're risking virtually none of your own capital.
It's the democratization of leverage. I mean, the barrier to entry for managing substantial capital has never been lower in history.
Which is great, right?
Well, yes and no, because that accessibility masks a really dangerous underlying psychological trap.
The gamification trap.
Exactly. The structure of the prop firm model,
Yeah.
Paying an entry fee, beating a challenge, unlocking a funded tier, it conditions people to view the entire endeavor through the lens of a video game.
Unlocking levels.
Right. Traders stop viewing the market as an arena of risk transfer and start treating it exactly like an arcade game.
And you can see it in how they talk online. They're obsessed with passing the challenge and unlocking the next level. But, okay, I have to push back here for a second.
Sure.
Because if you look at the source material, the notes detail how these amateurs are spending hundreds of hours studying. They're looking at order blocks, Fibonacci retracements, moving average crossovers.
All the classic technicals?
Yeah, complex candlestick patterns. They are putting in the screen time to learn the technical mechanics. So isn't it unfair to say they're just treating it like an arcade game? I mean, aren't those setups the very mechanics they need to master?
What's fascinating here is that obsessing over technical setups in isolation is the very definition of the video game mentality.
Wait, really? How so?
Well, think about it. When a retail trader stares at a chart waiting for the relative strength index to cross a specific threshold, or for a moving average to align perfectly, they are operating under the illusion that the market is a closed-loop system responding to their personal screen.
Like they're playing against the computer.
Exactly. They think if they input the correct sequence of technical observations, like a cheat code, the game's code will automatically dispense a reward.
A payout.
Right. But a financial market is not pre-programmed to respect a geometric line drawn on your monitor. It is a highly aggressive, reactive environment.
So they're basically playing single-player mode on a server filled with, like, institutional apex predators.
That is the exact blind spot. A chart pattern or an indicator doesn't move the price of an asset.
Right.
Only aggressive buying or selling moves the price. So when a trader focuses entirely on their own localized setup, they're blinding themselves to the absolute most critical variable in the entire equation, which is liquidity.
But if staring at MACD and RSI indicators on a screen is just playing single-player mode, how do you actually look across the server and see what the other players are doing?
You have to change your fundamental question.
Right, because the money manager's notes argued you have to abandon the search for the perfect setup and start asking one golden question before every single execution.
Who is on the other side of this trade?
Yes. Who is on the other side?
That realization that every transaction requires a counterparty is the dividing line between amateur and professional.
It sounds so rudimentary when you say it out loud.
It does, but the implications are really complex. Amateurs assume the counterparty is just another retail trader sitting in a basement somewhere, guessing on a chart, just like they are.
Just some guy.
Right, just some guy. But professionals understand the mechanics of liquidity provision. If you are buying a breakout at the absolute top of a trading range because your indicator flashed green, you have to stop and ask yourself something.
Why is someone willing to sell this to me right now?
Exactly. Who is willing to sell to you at that premium price?
It's like buying a used car on Craigslist.
Yeah, okay, I like that.
You don't just look at the shiny paint and the clean interior. You look at the seller and ask yourself, why is this guy so eager to get rid of this car today?
Right, what does he know that I don't?
Yeah. If you don't ask that, you're already at a disadvantage. It's like sitting down at a high-stakes poker table. You don't just look at your own two cards and bet based on their face value.
You have to play the other players.
Exactly. You look across the table at the chip leader who's been bullying the blinds for an hour, you study their betting patterns, and you ask why they're suddenly raving the pot when the board looks so dangerous. If you're only looking at your own hand, you are the mark.
You are the mark.
But taking that poker analogy into financial markets introduces a massive structural problem. Because in the market, it's entirely anonymous.
And that anonymity is the ultimate camouflage for institutional intent.
You can't see them.
You can't. You don't get to see the face of the hedge fund manager offloading risk, and you obviously can't read the body language of an algorithmic trading bot.
No, you just see a stream of numbers.
Just numbers and a price chart. And because the counterparties are invisible, human nature defaults to forgetting they exist at all.
Out of sight, out of mind.
Precisely. The market becomes a phantom. It's just this abstract line wiggling on a screen, completely detached from the billions of dollars of institutional mandates that are actually driving it.
Okay, let's unpack this. Because how do you fight a phantom?
It's difficult.
If the markets are completely anonymous, and we agree that we absolutely have to understand the intent of our counterparty to survive, how do we actually do that?
Well, they aren't totally invisible.
Right. The research we're reviewing offers this brilliant framework.
Yeah.
It argues that while the traders and institutions themselves are invisible, the sheer size of their capital forces them to leave recognizable fingerprints all over the market structure.
I really appreciate that framing institutional fingerprints, because it gets straight to the heart of execution mechanics.
How so?
Well, a retail trader can click a button and buy, say, 10 shares of a stock or one lot of a currency pair instantly.
Yeah, boom, done.
Right, and it doesn't move the market at all. But a massive institution needing to accumulate a $100 million position, they can't just hit the buy button.
It would be a disaster.
A total disaster. If they did, they would instantly consume all the available liquidity in the order book. They drive the price up against themselves and ruin their own average entry price.
Which is known as slippage, right?
Exactly, slippage. So to avoid that, they have to deploy algorithms to break that massive order into thousands of smaller pieces and execute them quietly over time.
Here's where it gets really interesting.
Yeah.
Because those algorithms are governed by time and volume parameters.
They're very strictly governed, yes.
And the veteran trader's notes provide a highly specific, recurring example of one of these behavioral fingerprints. He points to observing the price action as it gravitates toward the extreme edges, like the highs and lows of the prior 30-minute trading range.
This is a classic example.
Let me try to decode this before we go deeper.
Yeah.
If we are closely tracking the boundaries of a 30-minute window, are we essentially tracking where the heavy institutional volume got trapped earlier in the morning?
Yes.
Is that what creates the gravity pulling the price back to those edges?
You're hitting on the exact mechanism. Specifically regarding execution algorithms like TWAP, time-weighted average price.
Okay, I've heard of TWAP.
Right, so institutions often mandate their algorithms to execute a certain percentage of an order within specific time blocks. 30-minute intervals are very common.
So they have half an hour to buy a certain amount.
Exactly, and when that algorithm finishes its mandated execution block for that half hour, it temporarily steps away.
It just stops buying.
It pauses, and that creates a localized liquidity void. The aggressive buying or selling pressure just vanishes, and the price naturally drifts or sometimes snaps back toward the extreme edges of that 30-minute range.
So what does this all mean when the price actually hits that edge?
That's the critical moment.
Because the notes suggest that retail traders view that edge as a breakout opportunity, but the professionals view it as a hunting ground.
If we connect this to the bigger picture, we have to look at how retail traders are taught to place their stop losses.
Oh, this is the trap.
It is. Novice traders are universally trained by textbooks and YouTube courses to place their protective stop-loss orders just above the recent high or just below the recent low.
Makes sense. It seems safe.
It feels safe to them. So sitting right at the edges of that 30-minute range are large clusters of retail stop-loss orders.
Wait, and a stop-loss order on a short position is actually a market buy order.
Precisely.
Oh.
And what did we say the massive institution needs in order to enter a huge short position without experiencing slippage?
They need buyers.
They need a massive influx of buy orders to sell into. They need liquidity.
They hunt the stops.
Exactly. The algorithms will often intentionally push the price just past the edge of the 30-minute range. They trigger all those retail stop losses, forcing the retail traders to buy.
Which provides the perfect deep pool of liquidity for the institution to step in and sell.
Yep. The retail trader gets stopped out, they blame their psychology, and the institution gets their massive order filled at a premium price.
That is ruthless.
It's just mechanics.
But it makes perfect mechanical sense. It's like an auction house, right? Where the auctioneer is artificially driving up the bid using ghost bidders just to squeeze the absolute maximum out of the one guy who desperately wants the painting.
That's a great analogy.
The retail trader thinks a breakout is happening because the price crossed a line on their chart.
Yeah.
But the reality is the institution is just harvesting their stop losses for liquidity.
Which completely reframes how you have to look at the chart.
Yeah, you aren't looking for a geometric pattern anymore. You're looking for where the pain is. You're looking for the what the notes call the party at that level.
The concept of the party at that level is the perfect way to visualize it. When the price reaches those highly contested edges, a convergence of intent occurs.
You can actually see the collision.
You see the collision of retail panic and institutional accumulation. The critical takeaway here isn't that the price will always reverse at the 30-minute edge or that it will always break out.
Right, there's no magic bullet.
The market is not that static. The vital lesson is recognizing that a gathering of capital is happening at that specific coordinate.
You're watching the footprint being pressed into the dirt in real time.
Exactly.
You might not see the apex predator, but you can see the brush moving. You can see the depth of the footprint based on how aggressively the volume spikes at that exact price level.
You're reading the behavior.
Yeah, you're reading the behavior of an invisible entity based purely on the structural marks it leaves behind in the order book.
Which requires a fundamental reprogramming of how you interact with risk. I mean, the prop firm traders who fail are the ones who refuse to do this reprogramming.
They just keep playing the video game.
They continue to treat the evaluation as a solitary test of their ability to memorize chart patterns. But the prop firm traders who survive, the ones who secure funding and actually extract capital from the market over the long term, they're the ones who stop trading the chart and start trading the people operating behind the chart.
They stop trying to beat a machine and start learning how to read the room.
That's exactly it. Read the room.
They realize that a chart is not a mathematical certainty. It's a historical record of human aggression and fear and institutional necessity.
Yes.
They look at a sudden drop in price, and they don't just see a red candle. They see a specialized algorithm offloading risk into a thin market.
Right, they see the intent.
They look at a consolidation phase, and they don't see a boring sideways line. They see a massive fund quietly accumulating a position without triggering the alarms.
It is a shift from passive observation to active adversarial thinking.
Adversarial, I like that.
When you understand the mechanics of liquidity, order flow, and institutional mandates, the market becomes significantly less mysterious. It is no longer this chaotic force of nature that randomly rewards or punishes you.
It's not just weather.
No, it's a structured environment where larger participants are constantly solving the problem of how to move massive amounts of money without being detected. Once you view the market as a mechanism for institutional problem solving, your own strategy shifts from trying to predict the future to trying to identify which problem the institutions are currently solving.
So, as we synthesize everything we've covered in this deep dive, the mandate for you listening is clear. If you find yourself drawn into the gravity of the prop firm model, or, if you're managing your own capital in any financial market, you have to actively fight the gamification of the environment.
You really do.
You have to strip away the illusion that you are playing a single-player game against a neutral computer. Stop looking for the cheat codes and the perfect indicator settings. Instead, adopt the mindset of a detective.
Start looking for clues.
Start asking the golden question before every single execution. Who is on the other side of your trade, and why are they so willing to give you exactly what you want at this specific price? Look for the liquidity voids. Look for the behavioral fingerprints of your counterparty.
This raises an important question, extending far beyond the realm of proprietary trading, really.
Oh, how so?
Whenever we navigate complex, digitized systems, whether it's algorithmic trading or social media feeds or dynamic pricing models, how often do our failures stem from treating those environments as neutral utilities?
Oh, I see.
Right, rather than observing the aggressive, purposeful intent of the entities designing and manipulating them? Critical thinking and an understanding of structural incentives remain our absolute best defenses against the illusion of a clean mechanical system.
That is the perfect macro perspective to bring this all together. And as you step away from this deep dive today, I want to leave you with one final, slightly uncomfortable reality to go on.
I'm ready.
We've established that financial markets are ultimately driven by participants leaving recognizable structural fingerprints. We've discussed how institutions use algorithms that leave tracks in the form of time-weighted executions and liquidity harvesting at the edges of ranges.
Right.
And we have also established that the vast majority of amateur traders are treating the market like a video game, blindly chasing the exact same technical indicators, placing their stop losses at the exact same obvious levels, and clicking the exact same buttons at the exact same time.
The herd mentality.
Exactly.
Yeah.
So if you are trading based on the same textbook patterns as 90% of the retail crowd, does that mean the amateur trader's behavior is leaving its own massive glowing fingerprint on the market?
Oh, absolutely it does.
Are you out there staring at your indicators, desperately trying to track the smart money, without realizing that your own predictable gamified behavior makes you the perfect, highly visible counterparty for someone else to exploit?
It's a sobering thought.
It really is. Keep studying the order flow and keep asking the right questions. We will see you next time.